Welcome back everyone. In this video, we're going to take a look at 3 of the best dividend ETFs you can buy right now for consistent and growing passive income. Dividend ETFs are the easiest way for individual investors to purchase a diversified portfolio of blue chip dividend paying companies. They are the best option for people who want to invest but don't want to spend the time researching each individual stock on their own. The 3 ETFs we're going to discuss each have their own unique characteristics that separate themselves from the rest. One of the ETFs I consider to be the best balanced fund on the market. It offers mid-tier starting yield with strong dividend and share price growth over the long term. The second ETF is a high yield fund designed for those investors who are looking for the current high income into their portfolio every single month. The third ETF is focused on dividend and earnings growth year after year, offering a lower starting yield right now, but it focuses on holding companies who have shown strong earnings growth and high dividend growth for the past few years and are expected to continue to do so for many years down the road. And for each of these 3 ETFs, we're going to go over its fundamentals, the past performance, and the top holdings within each individual fund. But before we do that, I am going to ask you to please hit that like button and subscribe. I'm the Gen Z Investor, and on the channel we talk about all major stock market news, and we track the progress and the growth of my personal stock portfolio, which has now reached a value at $149,000. But now we're going to continue on into the first ETF we're going to go over. This fund I believe to be the best balanced dividend ETF on the market. It offers a nice mid-tier starting yield with very consistent dividend growth and share price appreciation over the longer term. And that is ticker SCHD, which is Schwab's US Dividend Equity ETF. It currently trades for just over $67 per share, and with all the recent market volatility that has really driven down equity prices as of late, it is sitting right around its 52-week low. So we can see you can purchase this widely diversified mix of dividend-paying companies right around its 52-week low. And if we take a look at the dividend history for SCHD, year after year we can see consistent dividend growth. Since 2011, the company in this fund has more than tripled its quarterly dividend payout, from 12 cents per quarter up to around 60 to 70 cents per quarter coming into your portfolio in pure passive income. So this company invests in blue chip dividend paying companies that have the ability to grow their earnings year after year and in turn actually grow that dividend payment to their potential investors. Now onto the highlights of the fund. This is a very low cost ETF with a minimal expense ratio of only 0.06%. This expense ratio is very low. It's not even noticeable taken off your total returns. They offer a diversified portfolio of companies, and they track an index that's focused on the quality and sustainability of dividends. And if we take a look, one purchase of one share of SCHD for $67 gives you exposure to 103 different dividend paying companies within this ETF's basket. And this is a major fund on the market with over $36 billion of net assets overall. And it's been in operation for over a decade, starting back in 2011. The average market weighted capitalization for the companies within the fund is 121 billion. So this focuses on large cap sustainable companies that have proven their operations are sustainable over the long term. It has an average price to earnings ratio of 14.38, a price to cash flow ratio just above 10, and some major return of equity at over 35%. So overall, the companies in this ETF are large in scale and offer investors some great return on equity, which is a common trait for some of the best dividend paying companies on the market. And if we take a look, this fund has seen some incredible returns since its inception and over the past 5 and 10 years. We can see the annualized returns over the past 5 years are greater than 10%. Over the past 10 years, it's sitting above 12%. And since 2011, when the fund was first created, it's averaged over 12.7% annual growth, which is very, very fast. This is rapid growth, and this compounding, if it continues over the long term, can really create wealth for many investors without doing much work. To employ your capital into a fund with a very minimal fee and earn an average of over 12% annually without doing any work is very, very impressive. This is one of my favorite dividend ETFs on the market, and if we take a look at the top holdings, these are very recognizable names. We have Merck as the largest holding at 4.47% of the total assets, Home Depot, Amgen, Texas Instruments, Pepsi, IBM, Pfizer, Verizon, Cisco, and Coca-Cola round out the top 10. And one thing I like with this ETF, they're all pretty much equally weighted. 4.4%, 4.08, 4.07, 4.06. The portfolio is not top heavy towards one or two individual companies. And going over the sector diversification, we can see that Schwab has done an excellent job of spreading out the fund's holdings across many different sectors in the market. Information technology makes up around 21% of the fund, followed by financials at just under 20%, and consumer staples coming in as the third largest, just around 14.7% of the total weight, and all the other sectors of the market make up a decent amount of the portfolio as well. So the fund's not top heavy towards one individual sector, it's nicely diversified across all the different sectors of the market, so you are getting broad-based exposure. And we can see 61% of the fund is invested in companies worth over $70 billion, and around 90% of the fund is invested in companies worth over $15 billion in total market cap. So you are getting a largely high-weighted, high market cap companies you're invested in when holding SCHD. So this is the first ETF we're going to take a look at in this video. It offers investors a balanced approach to dividend investing. And if we take a look now at the second fund we're going to go over, it is ticker SPYD, which is the S&P 500 High Dividend ETF, currently trading for over $35 per share. So this ETF is focused on providing investors with high current income with a yield above 4%. So if we take a look at the fund facts, it offers investors a high level of dividend income at this current point in time with the opportunity for some capital appreciation as well. And it's designed to measure the performance of the top 80 high dividend paying companies within the S&P 500. So in general terms, the S&P 500 are the 500 largest US-based profitable companies. And within that 500, this fund takes the performance of the highest yielding 80, and that's what they build up this ETF for investors to purchase. So instead of buying each individual high yielding company, you can get the top 80 providing the best yield right now by purchasing SPYD. And if we take a look, the average weighted market cap of the fund is at around $46 billion, and it currently offers a standardized yield at 4.9% and a fund distribution yield, which is the more common dividend yield used by investors, which is the last 12 months of payments all added up divided by the current price of around 4.5%. So of course, many dividend paying companies right now do offer lower yields of around 1 to 3%, but if you're in the range and you need some high current income right now, if you plan to live off your dividend income at this current point in time or very soon in the future, taking a look at SPYD may be a nice addition to your portfolio for a current yield at around 4.5%, diversified across 80 different holdings. And if we take a look at the fund performance, it was created back in 2015, so it's been operational for around 7 years at this current point in time, and its average annualized return since inception is at 9.28%, which is pretty consistent and pretty strong for a portfolio focused on high current income. And if we factor in just the past 5 years, it returns an average of 7.8%. So overall, for investors who are looking, they already have accumulated their capital, they've already built up a large value within their portfolio, and now it's time to actually live off those holdings. And instead of focusing on capital appreciation, they're really worried about that current income to actually fund their lifestyle and pay their bills. Earning 6, 7, 8% annually while collecting some high monthly passive income is pretty attractive for the investors at that stage of their investment career. And if we take a look at the top holdings, all the individual companies only make up a small weighting overall. So if one or two of the companies end up cutting their dividend, are no longer sustainable, or get dropped, it's not going to really impact the fund overall because even the largest holding, Cardinal Health, only makes up around 1.7% of the total ETF's weight. Some other major holdings you can see are ExxonMobil, Chevron, Phillips 66, Gilead Sciences, Darden Restaurants, and a few more wrap up the top 10. And if we take a look at the sector breakdown, the largest sector it's invested in is financials at 22%, followed by utilities at 15%, and then real estate rounds out the top 3. But overall, similar to the other fund, it is invested in all the different sectors of the market, so you are getting some broad-based exposure. This ETF is a great option for those investors looking for that high current income right now and those monthly distributions into their portfolio. So SPYD was the second fund we're going to take a look at, and now if we move on into the third and final ETF within the video, it is ticker VIG, which is Vanguard's Dividend Appreciation ETF, and this fund currently trades for right around $136 per share, and this is a fund focused on long-term dividend appreciation and long-term sustainable dividend growth. And if we take a look at the fund's distribution history, back in 2006, it was paying out between 10 and 20 cents per share per quarter, but if we fast forward to today, it is now paying out more than 70 cents per share per quarter in dividend income. So we've seen some major dividend growth from this ETF since its inception back in 2006. And if we take a look, it is out with a very minimal expense ratio of only 0.06%, the same ratio as SCHD. And this is Vanguard's portfolio that tracks the S&P 500 US Dividend Growers Index. It's a passive ETF. It's a fully replicated approach. It tracks that index to a T. No one's actively managing this fund. There's no investors buying and selling on a daily basis. Every quarter they just do a rebalance and hold the companies within the fund with very little trading activity, and it always remains fully invested, and it emphasizes the companies who have a record of growing their dividends year after year, and they do this by minimizing expenses, keeping that ratio very low, so all the growth of the underlying companies gets passed on directly to the individual shareholders of this ETF. And we can see within the fund, there's 289 different companies. So now if we compare to the other two funds we've taken a look at, SCHD holds 103 companies. SPYD owns 80 companies, and now VIG has 289 different stocks within the portfolio, so this one's much more diversified, and overall, with 3 dividend ETFs, they're very, very different. Of course, we've already taken a look at 2 others who have a very different investment style compared to VIG, and even within the underlying holdings, they own 289 compared to less than half for the other 2 stocks we've taken a look at. Their median market cap is around 143 billion, and these are companies with very fast earnings growth with an average of 15.6%, a very reasonable PE ratio of around 20, and overall return on equity very high once again at over 24% on average for this overall portfolio. And if we take a look at the performance, over the past 10 years, it's averaging 10.7%, so a very respectable return. Over the past 5 years, it's at around 9.4%, and since the fund was created back in 2006, it's averaged around 8.4% per year over the longer term. And taking a look at the top holdings, again, we have some very recognizable names in some of the top dividend companies on the market with United Health, Microsoft, Johnson & Johnson, Procter & Gamble, JP Morgan Chase, Visa, Home Depot, MasterCard, Coca-Cola, and Pepsi. So there are some overlap between funds. In the top 10 ETF for SCHD, Pepsi, Coca-Cola, and Home Depot are in the top 10 of that ETF as well, making up a different weight. And we can see overall, United Health does make up a significant portion of the fund at 4.13% compared to Pepsi, who comes in 10th with only 2%. So there is a little bit more of a discretion in the weighting of the holdings even within the top 10. And if we take a look, it is diversified across multiple different sectors. The largest is tech at around 23%, followed by healthcare at around 15%, financials at around 15% as well, and consumer staples at just over 13.6%. So overall, another ETF focused on dividend growth, a different strategy compared to the first few ones we've taken a look at, but overall it does give you another option of a potential dividend ETF that may be a great fit for you depending on your personal investment style. If you want a lower starting yield of only 2% because you don't really need that income right now and you're looking to invest in companies who have that ability to grow the dividend over the long term, VIG may be the holding for you. So overall, those were 3 different ETFs to take a look at. They're all dividend-based funds with 3 different investment strategies. I hope I covered one that fits your own personal investment style. I think dividend ETFs are great options for the investors who don't want to spend the time to research each individual companies, but want to invest in some of the strongest blue chip names on the market. So thank you for watching the video all the way to the end. I'm the Gen Z Investor. Please hit that like button and subscribe, and I will see you in the next video.